Hello, and welcome to the 67th edition of Crossing Thin Ice, a podcast series about risk management for insurers. I'm joined today by Max Rudolph. He will be providing an in-depth look at investing for float, which is applied across different types of insurance, from short-duration policies like property and auto to long-duration products such as life insurance and annuities. Max also addresses the benefits and significant risks involved, including the potential for systemic risk and the role of regulators and guarantee associations in a competitive market. Please be aware that nothing in today's podcast should be interpreted as investment advice, but it is sure to be educational and thought-provoking. Let's get started.
An insurance contract collects premiums and pays out benefits when a claim occurs. The insurer invests the proceeds, called float, bound by asset liability management or ALM and/or liquidity constraints, but often managed separately from the liabilities. It has similar financial impact to taking out a loan for the insurer. Insurers have reserve and capital requirements directly from regulators and indirectly to obtain a desired rating, with leverage defined as the assets under management, or AUM, divided by economic capital. Policyholders in the U.S. receive partial solvency protection from state-based guarantee associations who assess solvent insurers when an insolvency occurs. For an investor who can earn excess returns, insurance float can be a successful strategy. Benefits and risks of float vary based on the type of insurance. For example, an auto policy collects premiums for a 6-month period and pays out claims as they occur. A life insurance policy may collect premiums every year until death. The duration of the assets backing a block of these life policies is much greater than for a block of auto policies. Thinking of it like a loan, the cost of float is the underwriting loss with a combined ratio above 100%. And an underwriting profit allows some insurers additional investment flexibility. Property and health insurance reprices frequently, so premiums collected are held for only a short time as claims are typically paid within a year. Reserves for future claims are not discounted with interest. Investments for a single policy need to be of short duration, but once the insurer has built a stable block of policies, the law of large numbers allows investments to be longer, while remaining liquid for conservatism if a rash of claims occur. A strategic focus on float makes sense. Typically, health insurers invest very conservatively, focusing on their specific expertise to manage liability risks. Smaller firms, especially if they are geographically concentrated, buy reinsurance to offset large aggregate claims from a hurricane, fire, or earthquake, but this leaves a smaller amount to invest. So profit is based on liabilities rather than float. A large insurer or reinsurer has more assets under management and greater diversification from liabilities, so can invest in more esoteric asset classes and accept greater ALM, credit, or equity risk. Float may be key to their success. The other investment strategy twist for short duration products is if their combined ratio is regularly less than 100%. Creating an underwriting profit and implying less competition. Property insurance data for large insurers is credible for several years into the future, although climate change is driving claim trends higher. Investments for this type of business have more flexibility to break from ALM constraints and manage assets separately from liabilities. Most insurers continue to use high-quality fixed income, but some take on more risks. This can be ALM, measured by duration and convexity, credit, or liquidity. But stress tests can determine limits to the strategy that will maintain a sufficient cash flow stream. Life insurers and long-duration health and property writers typically write a variety of general account product types. Annual renewable term life insurance has similarities to short-duration property liabilities, but longer-duration general account contracts like whole life have different characteristics. Premiums are typically level, so exceed that is needed in early years with the reserve liability set up. Policyholders have liquidity options using cash surrender values, leaving insurers susceptible to a run on the bank. For life blocks, ALM becomes more important. Investment cash flow amounts and timing are key, so credit, liquidity, and interest rate risks need to be managed. Solvency can be threatened by mismatched asset and liability cash flows, especially when leveraged. Models must consider assets with no cash flows until maturity, uncertain timing and amounts of cash flows, uncertain defaults and recoveries, and liquidity challenges. Assumptions should be conservative and not hide behind actuarial judgment when challenged. Net expected spreads, so post defaults, for new asset classes that have not completed a credit cycle should not exceed those of similarly rated bonds. There's no free lunch. Higher spreads likely means that markets have identified a new risk. To protect policyholders, float for life insurance blocks have tight ALM constraints, so are poor candidates for aggressive investment strategies based on float or leverage. Fixed annuities convert a single premium into a stream of fixed payments. A product offered by new entrants and existing insurers offer pension risk transfer contracts that replace an employer-sponsored defined benefit plan with a standard annuity contract. Since there are no incoming cash flows after issue, tight constraints to manage interest rate risk and conservative practices around credit risk are important. There are limited liquidity options for the policyholder. These products are fragile to longevity improvements and have high leverage due to a combination of high AUM and low capital requirements. This creates an incentive to seek out regulatory arbitrage opportunities where capital lags the risk, so returns appear outsized, and an interest in investing for float where both the risks and opportunities are high for the insurer. Deferred annuities often collect a single premium and marketed as alternatives to CDs are expected to roll over into a new contract when the surrender charges expire. Annuity pricing is highly competitive, so the policyholder gets the benefit of investment expertise. Float as leverage has less benefit unless outsized risk is accepted via duration, credit, or liquidity risks. Tight ALM constraints tied to product pricing makes it risky to make speculative investment bets using credit risk or timing risk from asset-backed securities. Large insurers with short duration business, especially those who generate underwriting gains from property casualty business, can use float as an investment strategy to add value to shareholders. Life and health blocks, along with deferred annuities, are not good candidates. Due to the high leverage ratio associated with payout annuities, so lots of AUM and little capital held, these investors who believe they can anticipate interest rate movements could accept enterprise duration mismatches, thus making a bet. If correct, they receive hefty bonuses. But if they're wrong, it leaves policyholders reliant on guarantee associations. When new competitors introduce risky strategies that incumbent insurers need to mimic to remain in the market, insolvencies could lead to reputational risk for the industry. These practices increase fragility and are not resilient practices. For an industry that relies on client trust, reputational risk is systemic.
All right, Max, I've got some questions for you about this idea of investing for float. Can you walk us through an example of leverage for a couple of different insurance products?
Sure, Dave. And this is one where if somebody really wants to understand it, they really want to do kind of a Google search to look at some formulas and things like that. But I'll do my best here with a qualitative approach. Leverage can be measured for an insurer at the product line or enterprise level. But in each case, you divide the assets under management, or AUM, by the measured capital. Proxies for product line AUM are reserves, and the denominator could be economic or required capital. Economic capital is the present value of future cash flows, and required capital is risk related and defined by a regulator, rating agency, or even internally to the company. There's a risk of regulatory arbitrage with insurers seeking out low capital requirements when you're calculating this formula. For the enterprise, you can use the actual assets from the balance sheet and divide by the surplus amount. If your goal is to make bets around interest rate risk, you want leverage to be as high as possible. So products with high levels of assets relative to the capital that is being held. Annuities are preferred. It only takes a small duration mismatch if the leverage is high to create a large interest rate bet for an insurer. This seems to be a risk that could cause a problem if regulators don't create transparency around the enterprise duration metric, um, similar to the Silicon Valley Bank or SVB crisis when interest rates rose in 2023. Single product companies that focus on competitively priced annuities seem to be at greatest risk. On the transparency side, derivative markets make it possible to report metrics on a single day that can be unwound the next. It's important to follow regulatory principles. So maybe looking at what that leverage would be over several different points in time or the average of several points in time. So using principles rather than rules in this case, so the company has to defend their assumptions publicly. Dave, do you
Just
have anything to add on that?
Yeah, I'll just add on that. I guess some of this discussion on float was very confusing to me when I first started hearing it and I first started working with property and casualty general insurance companies. As a lifetime life actuary, I did switch into working with non-life companies in the last 10 or 12 years of my career, and I eventually figured this out. And it's fairly simple in that. This idea is very powerful in the property and casualty business because in general, the reserves are set without regard to interest rates. And so the reserves are just a sum of the expected payouts on the claims uh, with no discounting for deferred payout of the claim. So the power of interest in that, in terms of its impact on profitability, is much higher than for life insurance, where for most life insurance products, a very high percentage of the interest earned is credited to the policyholder.
Yeah, and most people think of short term like a car insurance or a homeowner's insurance, but the same rules apply on the casualty side where you might have a workman's comp claim that goes for many years, so it becomes very material.
In the case of those very long duration claims, there is some discounting of
There
those.
is some.
So
Okay.
yeah, so they do work a lot more like life insurance reserves that way.
Okay.
Let's get back to our discussion of our topic. How does the role, Max, of guarantee associations change the role of regulators and competitors?
Well, this is something I've been thinking about a lot lately because it's the relationship between these guarantee associations and insurers is unique. There's some guarantors for other types of companies, but they tend to have access to the federal printing press. In this case, the guarantee associations rely entirely upon competitors to help customers of insolvent insurers recoup their money. This means that there are incentives for competitors who see something that someone's doing that they think is risky to notify regulators, since they will be assessed real money if the competitor becomes insolvent. Now, there's caps on customer claims, but there's a potential systemic risk, I think, if a competitively priced product sold by lots of companies takes on too much risk. There's a risk of a spiral where the weakest competitor goes under, and so then the assessments are made, and that takes out the next lowest rung. Then there's another round of assessments, and so on. No one wins. The guarantee associations are operated by each state, often with small staffs. Historically, there have been few insolvencies in the industry, and when they occur, it's historically been due to regional concentration of property insurance following a hurricane or earthquake event, or single state companies with poor pricing, or investment losses from concentrated positions. I worry that some very smart operators have bought insurers and rely on this put. If they make money, large bonuses are paid to management. And if they don't, they just walk away with, and there's no clawbacks to help pay the policyholders. Dave, have you had interaction with the guarantee associations in the past?
Not personally. The first time I had some exposure to this, though, was when a friend of mine was named the executor for a company that did go into receivership. So I just in informal conversations with my friend, I heard a lot about the ins and outs and the ups and downs of that process. The biggest recollection I took from that was along the lines of what you were saying, Max, of the industry having to pay the bill for that. Is that that is not a popular process at all. The insurance companies complained loudly every time a bill went out. They felt that the ones that were running their businesses responsibly, were having to pay for the companies that were running their business irresponsibly, and they were all over the regulators about, well, why weren't you stopping this before it got this bad? And so there was a quite lively discussion involved in that process.
Yeah, one of the first presentations that I did after I went out on my own as a consultant was to a National Guarantee Association meeting to talk about pandemic risk and how that could play out. And it was interesting. It really came across that insurance companies have a whole lot of resources relative to the Guarantee Association. So I can see where they would bully them if there were assessments being made. So that story doesn't surprise me at all.
The other thing I'll mention, Max, is that management put that you mentioned. I've seen it written over and over again that management put exists whether or not there is a guarantee association. That management does not get a bill for the losses of the company in any situation. It's just a question of whether management cares whether or not the policyholders are made whole. And in some cases they do, but in some of the cases where companies are run into the ground, it's because management didn't care whether or not the policyholders were made whole.
So insurers, I guess our message to them is think about your policyholder, try not to run your company into the ground because the reputation risk to the industry is huge. I mean, for an insurance company, you're making promises that sometimes are 20, 30, 50 years out. And if some companies lose their reputation, it carries over into everybody.
For sure. So, Max, you said earlier that for an investor who can earn excess returns, that insurance float seems like a real successful strategy. What are some of the less obvious risks that are associated with that kind of strategy that relies heavily on that float, and particularly for a company with short duration liabilities like an auto insurer or something?
Yeah, one way to think about an insurer's strategy is based on their expertise. You know, are they collecting premiums from liabilities so the investment team can work their magic, or does the product team expertise dominate with investments expected to be safe and reliable? In the article, I talk about insurers with an underwriting gain, where investment returns are in addition to the profit from the liabilities. It's the Berkshire Hathaway model, but few other than Warren Buffett and Ajit Jain have successfully steered this strategy through the down part of a credit cycle. I worry that the industry is susceptible to the next one. Liquidity risk is always the reason a business goes insolvent. You know, Hemingway was right with his term, his view of, how did you go bankrupt, slowly at first, then very suddenly. That's liquidity risk. So not enough cash in to pay the required cash payments out. Very simple. Short duration liabilities are especially sensitive to this because once premiums are invested, a problem can arrive very quickly. Could be credit risk or interest rate risk, but when a claim is not paid, the reputation risks can generate a run on the bank and high lapse rates that go along with that.
Max, you highlighted higher spreads for new asset classes are often a signal of some new or unknown risk. How would you, as a risk manager, approach the due diligence for investing in new unproven asset classes to ensure that compensation for the risk is appropriate?
Well, you can always do more than what I'm going to suggest, but to some degree, this is where foresight and experience comes in. You may not be able to quantify it, but the NAIC's recent attempts to align model spreads with those of rated bonds is a good effort. If it seems too good to be true, it probably is. And you should limit or avoid an asset class you don't fully understand. Dave, have you seen any tools that work well for new asset classes?
There's two that come to my mind that I've seen. One of them I'm surprised to recall and tell you this is something that came up a very long time ago when the company I was working for was first looking at risk-adjusted views of its business. We did that risk adjustment through our capital formula, and the investment department wanted to invest in some new asset class that looked attractive to them. And we went back and forth as to what the capital formula should be. And in the end, they decided, certainly we were very much in support of this on the actuarial side, that the capital level for this asset should be something that on a risk adjusted basis put this asset class right in line with every other investment. In that case, when you made that decision to use that investment, you were allocating capital that made sense according to the spreads you were getting on the investment. So exactly the kind of thing that you've been advocating, Max. And I'm saying I'm surprised at this because this is very early days of us applying this kind of methodology. And but the investment folks, while they wanted to do this investment, they didn't think it was appropriate to show it as an extra special investment until after the experience emerged, which is what you get by signing the capital that way. The other methodology that I've seen used many times, many places, is a simple one, which is just limiting the amount to which you go into these new investments, so that even if you've got it all wrong, the risk of the investment, for instance, is much higher than you're being paid for with the excess spread you're seeing there. It's not something that's going to cause you to have a bad year. It might cause you to have a bad quarter, and those are kind of the ways that I've seen people set their limits on that as to what could I lose on this? A common thing with that is, well, I could lose a quarter's profit from the business unit that I'm investing them in, for instance, as a way of backing into how much of that new investment that I'll take.
One of the books on the syllabus for the CFA charter talks about the difference between core and satellite. And then you can apply this to both liabilities and asset classes. But you have certain qualifications for it to be a core, let's say core investment. If it makes the cut there, then you can buy as much of it as you want. But if it's a satellite investment, it's really something that you're just trying out for new, or it has some characteristic that makes you not want to just go wild with it. So for that, the example I always use is on the liability side. You get some new annuity product that you're just trying out. You don't want people to be able to just go crazy and bring in, $10 billion on day one. You want to kind of start slow and make sure that you're set up and you have your logistics set up and your operations and everything. So that's kind of interesting.
Not exactly the kind of restraint, though, that you're seeing from some of these players that are investment managers that are taking over insurance companies.
Right. That's going to be a case study that we'll study for years to come if it plays out as I expect it to.
Right. So, Max, you suggested earlier that the float for life insurance blocks has some pretty tight ALM constraints. If you were the CEO of a life insurance company, what kind of steps would you take to ensure that your investment strategy stays in line with those ALM constraints, but still somehow or other seeking that profitable growth that is your real sweet spot?
I would set up to regularly receive a report that showed product line and enterprise duration and convexity metrics, along with graphed historical results quarterly of reserves, premium, capital, asset balances, and yields, all by product and by asset portfolio. So I or others could seek out abnormalities. A lot of times you look at that picture and you say, well, why did this jump so much, or why did it fall so much, or why is it the same when Rates have gone up by 100 basis points in the meantime. But it's a place to start to ask questions. I would make sure for products with high interest rate risk that the board regularly discussed and understood the ALM metrics by interacting with the team that generates them, not just relying and having it be a consensus item that you just check a box saying, yeah, I received it. I've found that the modelers who understand these nuances and actually build these models eventually make very good managers of product lines as they gain experience. So an investment in their time and knowledge really pays dividends down the road for a company.
Today, we learned that while investing for float can generate significant value for investors who are able to earn excess returns, its application is nuanced. The risk profile differs greatly between insurance types. And also, we learned that reaching for excess returns sometimes come with a high asset liability mismatch and an elevated risk profile. We hope that you've enjoyed this edition of Crossing Thin Ice, and if you did, please like, subscribe, and share with your friends.